Hello everyone, this is Mr. Stocky. In my previous video called Maximizing Returns, I spoke about the philosophy behind my investment approach. Today we're going to take a detailed look at how I go about implementing that philosophy through the portfolio design. First, the disclaimer. Just to let you know that this video is for information purposes only and is not meant to provide personal financial advice. Okay, let's quickly recap my return philosophy. If you want more details, please refer to the Maximizing Returns presentation. There are three sources of return that I'm aiming to exploit: alpha, beta, and hedge. Alpha is the source of return that is derived from my skill as a short-term trader. The alpha return is independent of the second source of return I am aiming to capture, and that is the beta or equity market return. The equity market return is obtained by an investor by simply passively invested in the market. The rationale for capturing this return is simple. Historically, the equity market has produced a 10% compounded annual rate of return. Additionally, 70% of those years have been a positive returning year. Unlike alpha, this is a return that is obtained through no skill or effort. The market return is almost like a free gift given to an investor for participating in the market. But it isn't free. 30% of those years have experienced negative returns, and some of those were especially bad, such as in 2008 during the global financial crisis, where the market dropped by the value of 50%. This is the rationale for the third source of return. The hedge component is all about loss protection and risk management. My aim is to capture the bullish periods of the market return. We want to avoid the bearish periods. This is done with the aid of the alpha or the short-term trading skill. If done properly, the alpha, beta, and hedge components will produce a very attractive rate of return over the medium to long term. Now let's see how all this works in practice through the portfolio design. I thought the best way to show you the construction of the portfolio is to illustrate this through a chart. Here I show the S&P 500 equity market return in 2023 as represented by the SPDR ETF SPY. I'm using 2023 as an example because it is a typical bull market. Firstly, let's look at the beta return component. That is the market return that we are trying to capture within our investment approach. It is the return that is obtained through no effort or skill. In 2023, the return would have been a nice positive 25% for the year. That's indeed a very nice gift given by the market. But the question is, can we improve on how we obtain that return? Can we obtain a higher return or a similar return with a lower risk? Remember, not all years are going to be smooth sailing like this example. Our objective of the beta return is to capture the bullish periods and avoid as much as possible the bearish periods. So let's break down the chart into smaller segments. In any given year, there are bullish and bearish periods in the market. In this example, we can see this by dividing the market into those segments. The uptrend are the bullish periods, and downtrend are the bearish periods. By being able to detect the bearish periods, we can use our hedging strategy to avoid them. To do this, we can either reduce our risk by taking money out of the market and sitting in cash, or if we want to stay invested, we can short the market during the downtrend and hedge our exposure. In order to hedge successfully, we have to be able to find a reliable method or strategy to detect these bearish periods, or should I say potentially bearish periods, since we don't know that in advance. This is where the alpha short-term trading strategy plays an important role. In this example, we can see the trade signals as represented by the green and red arrows of my short-term trading strategy, or the alpha strategy. As you can see, green arrows represent periods where we are expecting bullishness in the market, and largely you can see these during the uptrending periods. The red signals, or the bearish signals of our alpha trading strategy, tend to occur during the down periods or the peak of markets. Of course, we don't have perfect foresight into what the market will do in the future. We don't have a crystal ball. We can't capture every bullish or avoid every bearish period. We may miss some opportunities completely and badly mistime others. But as long as we can consistently apply our strategy, we should get a satisfactory overall outcome. Now let's get even more granular and see how the actual trading of the strategy works in practice. To do this, I show the patchwork. The blue segments represent strong expectations of bullish market conditions. The gray, moderately bullish expectations, and the pink segments represent weak market conditions that we are expecting in the short term. Attached to these segments are the amount of risk we can choose to take. In this example, 100% in the blue segments, meaning that we are fully invested in the market at that particular period in time. 50% means we are 50% invested and 50% sitting in cash during the gray periods, and 25% invested or 75% in cash during the weak or bearish periods of market expectations. We can adjust these numbers based on our risk profile up and down to our liking. Overall though, the effect should be that we participate as much as possible in the uptrends and as little as possible in the downtrend. The patchwork is the foundation of the investment strategy. It is the beta and hedge components at work. This is a largely long biased strategy, meaning that we are hoping for the market to move higher over the medium to long term. The reason for that was explained statistically, given that markets tend to move higher over the long term. To maximize returns, the advanced approach that I've taken is to overlay this patchwork with the alpha components, as was shown by the red and green arrows. We use the alpha component to dial up and down our risk with more precision. For example, during a bullish period, we may want to add more long positions in excess of the 100% that is already invested as the baseline in the market. We want to do this for a short period of time and capture the additional return through that bullish period. Conversely, in a bearish period, we can use our alpha signal to dial all our risk down to zero, or if it is a very strong high conviction signal, we can choose to actually short the market and try to profit from a falling market. In this way, we can benefit from both a rising market and as well as a falling market. By designing our portfolio in this manner, we can actively respond to dynamically changing market conditions. It gives us the best chance at meeting our investment objectives.